Evening, everyone. Hopefully everyone can hear me okay. Please do let us know if there are any issues. But firstly, thank you all very much for joining us. Obviously, it's quite an important and interesting time of the year with the budget yesterday. So both Carlo and I wanted to give you a bit of an outline of the key announcements, how it impacts us as both expats and Australian residents, and I guess some of the things that may have been missed in terms of the budget. Now, a little bit of housekeeping before we actually get started. You'll note we've got both the chat and the Q&A box. We'll keep this as interactive as possible. So if you do have any questions as we go through, pop them in either Q&A or the chat box. We'll be sure to get to them all this evening. We have capped this at an hour, and there's a fair bit to get through. So we do want to be respectful of everyone's time and just make sure that we're not actually exceeding 7 p.m. WA time or Singapore time. But yeah, as I said, if you do have questions, just pop them in either channel and we'll be sure to get to them all this evening. So let's get on to the topic of this evening, and that is the 2020 Australian federal budget. Now, before we get into the context of this evening and introduce Carlo and myself, a bit of a disclaimer: everything you hear here tonight is for information purposes only. It is not personal advice. If you do need personal advice or are wondering how this impacts your personal situation, please do consult a professional. Both Ally and Global Financial Consultants are licensed Ally in Australia and Global Financial Consultants in Singapore. So if you do need advice, be sure to consult a professional, whether it be tax or otherwise. So let's get into it. Carlo, I'll hand over to yourself just to give us a brief introduction of who you are and why you're here.
Good evening, everyone. Just a bit of an introduction on Ally Wealth Management and who we are. Many of you know we provide financial services to both Australian expats and Australian residents. We provide a vast array of services, which include all the ones that you can see there, plus also, which a lot of people don't know, is general information on foreign exchange. We're based here in the heart of South Perth, Western Australia, and we've got clients all over the world.
Brilliant. Thanks, Carlo. And for anyone who doesn't know me, I'm Jarrad Brown, usually based in Singapore. And oddly enough, both Carlo and my background this evening are in Singapore, even though we're both currently based in Perth. Carlo on a more permanent basis than myself, but I have every intention of jumping on a plane next Monday and returning to my home in Singapore. So looking forward to getting back to the warm weather. But on to more important topics. So a little bit about GFC myself. For anyone who's not already aware, I made the shift to Singapore about 7 years ago. We set up Australian Expatriate Group to provide financial advice to Australian expats all over the world, and have obviously aligned with Ally Wealth Management to provide advice to our Australian expat clients and Australian resident clients on the ground in Australia when it comes to superannuation, repatriation, all things Australia. I think one of the most important takeaways for both is that they are not owned or licensed by or authorised by any of the insurers or banks, which for anyone who's been paying attention to the Royal Commission and everything that's unfolded there, that non-alignment is incredibly important when it comes to receiving advice. But wonderfully, GFC also was actually originally set up in Sydney in '97 and is now one of the longest standing non-aligned financial advisory firms in Singapore. Been there for around 17 years now. So wonderful to see that connection to Australia continue to grow and strengthen. And as Carlo's already touched on, we provide advice to Australian expats, and that's what we do on a day in, day out basis. So let's get into this evening. So the budget was released yesterday. It was all things as was expected, I think is the simplest way we can highlight it. It was all about spending. It was all about jobs. There were lots of areas that were not covered, both for residents and expats. And that's what we're going to cover here tonight. So we're going to go through some of the highlights, some of the economic forecasts, Carlo's going to share how some of these changes impact residents, so Australian residents, I mean, what opportunities are there, what changes we need to be aware of, and I'll also run through some of the highlights and changes for expats, as well as some of the things that were missed. So Carlo, I'll hand over to yourself to run us through some of the highlights when it comes to the budget.
Okay, budget highlights. Before we get started and crunch through the numbers, we need to realise that these are only announcements. The budget needs to be passed through the Parliament. It won't have any issue in the House of Reps where the government holds a majority, but it needs to get Senate support. So what may or may not happen, there may be some changes to the final outcome. So just bear that in mind. But let's have a look at the numbers anyway. So we've got a budget deficit for this year, 2021, of 213.7 billion, which is a bit of a different scenario 12 months ago with the catch cry back in black and back on track. So a bit of a change, and we all know the reason why behind that. There's another 111 billion for new COVID spending this year. Again, there's no surprise in that at all. The GDP for 2021 is at minus 1.5%, considering that we are in a technical recession, which means we have 2 quarters of negative growth. Again, no surprises there. The net debt is going to be 703 billion, which is 36% of GDP, and peaks in 2024 at 966 billion at 44% of GDP. Just to put those numbers into context, the UK, its current debt to GDP is at 100%, and the United States debt to GDP is at 125%. The forecast growth for next year is at 4.75%. That's probably a little bit on the optimistic side, I would say, but we'll just have to wait and see. Okay, the budget highlights. This is basically a snapshot of what was delivered in the budget itself. We will actually go into a bit more detail on each of those slides as we go through it. So the first one was tax relief. The Australian taxpayer gets a whole lot of tax cuts, affecting about 7 million of them who will benefit from that. There is a carried back tax loss for businesses and an instant asset write-off for businesses. As I said, we'll cover that in more detail later on. Job creation, we've had Job Seeker, we've had Job Keeper, and now we've got Job Maker, looking at 450,000 jobs for the 16 to 35-year-olds. There's another $1 billion in job training to come through. Apprenticeships are big winners in this if employees want to hire apprentices. R&D, the $2 billion, this is apparently was flagged 2 years ago. There's been a slight tweak to it, so that's just a bit of a rehash. Infrastructure, which is always a good thing when your economy is in a recession, is $14 billion to be spent on infrastructure. I'm not sure which projects are shovel ready, and what I mean by that is that they're ready to go immediately. Generally, infrastructure projects take a while to plan, develop, and implement. You just can't sort of build a bridge from one side of the city to the next in a couple of months, or get started in a couple of months. So we'll have to wait to see a bit more detail on that. The environment picks up, the national parks pick up 233 million, ocean protection 67 million, and recycling infrastructure 250 million. On the healthcare front, NDIS receives another 3.9 billion. It seems to be a bit of a drain. I think if you look at the budget papers, the NDIS, but they receive another 3.9 billion, and another 23 additional home care packages equating to 1.6 billion. Cyber security, which is a big thing, and I would no doubt see that increasing, they get 1.7 billion. Superannuation, probably slightly disappointing on the announcements. There's really not a lot in that, but we'll touch on that in more detail as we go through it. Okay, the economic forecasts. Forecast 3.75 contraction for this year. Again, no surprise there. As I've mentioned, the 4.25 GDP for next year looks a little bit on the optimistic side. And I'd also say that the 1.5% wage growth looks a bit optimistic. But we'll just have to see how that plays out. The interesting thing is, with the borders closed and everything else that's going on, we've got a net migration position of 2021 of negative 72,000. And that picks up to, if everything goes back to normal, to 201,000 in 23-24. Inflation forecast looks about right at 1.5%, well within the RBA's band, so that all looks okay.
Yeah, I think that's a very good snapshot, Carlo. And I think the only thing to add there is, for all of our attendees who are in Singapore and particularly Asia, I think everyone would be well aware that Australia is one of those countries where you can open the door and everybody wants to come in, as opposed to, say, Malaysia, where you open the door and everybody wants to go out. So that migration number, I think, will be a very easy one to turn back on. But the question is, where do they come from? How quickly does it happen? And what do those numbers look like? And I guess what incentives do we actually offer them as a country in Australia?
This is an interesting chart. A lot of people ask me, how much tax do I pay and how much does it raise? Most people are individual taxpayers in Australia. And as you can see from the first chart, it raises 222 billion. I would say that's approximately, it's about nearly half of the total income that the government receive. Between that and the company tax rate, you're looking at a good 60 to 65%. So very sensitive towards individual taxes being collected and company taxes being collected. If you look at the expenditure side, absolutely no surprise that social security and welfare chew up quite a bit of it. In fact, individual taxpayers basically fund the social security and welfare bill. So it's quite interesting to have a look at, see where the expenditure is going. Health, again, is 93 billion. It's quite a bit. Defence has been stuck on about 34 billion for quite some time, and we'll just have to see what happens there. But that's just a quick snapshot to see. It's quite interesting to see where your taxes go, who pays the most of the taxes, and we still are very, very reliant on individual taxpayers. So we'll see what happens.
Brilliant. And I think for those of us that are truly based in Singapore and paying taxes in Singapore, we may not be terribly unhappy not to be fully funding those social security and welfare payments, but I'll leave it for everyone to judge. Now, one of the most common questions we get asked, and Carlo, I'll jump in a little bit here in terms of forecasts, is where is the Aussie dollar going to go? Obviously, we've had a wild ride since COVID really took hold in the Western world. It was all kind of business as usual until about the 20th of March, and by the 23rd, the Western world was shut down. We saw the Aussie dollar relative to the Sing the Sing relative to the Aussie, I should say, go to about 125, and very quickly we got back to parity, and we're now trading at around the 102 level. The forecasts against both the US dollar and the Sing dollar are relatively similar, and that is that we will see a slight or gradual weakening in the Aussie dollar. Iron ore is relatively high, and we'll get into some of the forecasts, particularly what Treasury is forecasting there when it comes to the iron ore price. The risk of Australia losing its AAA credit rating seems to have dissipated. So again, that's providing some strength to the Aussie dollar. And Australia is largely viewed as a bit of a safe haven when it comes to Australian government bonds, Australian term deposits, and I guess just the safety of our currency. So overall forecasts at the moment, and take these forecasts with a pinch of salt because the world is changing on a daily basis, but the forecast is largely for a sort of 5 to 10% reduction, I guess, and a fairly gradual reduction at that relative to both the US and Singapore dollar. Now, the other key question always when it comes to the Australian budget is what could go wrong? And the list is probably much longer than this. But we really wanted to hone in, I guess, on some of the key forecasts when it comes to what Treasury is forecasting when it comes to the economics and what could change. Now, one of the most surprising factors has been the iron ore price. Now, Australia, as will come as no surprise to anyone, is very much a commodity-based country and currency as a result. We're trading at around the $120 to $130 a tonne iron ore price. And Treasury's forecast is that that will drop to $55 a tonne. Now we're talking US dollars by June of next year. That's a significant reduction. And the question is, what impact does that have on our share prices of the commodity players? So Fortescue, BHP and Rio particularly. What happens with South American supply? What happens with our relationship with China? There are a number of variables that could impact that iron ore price, but that's what is built into the Treasury forecast. So quite conservative, you might argue, but that is the number. Now, the other key variable is they have assumed that state border restrictions will open up by the end of 2020, with the exception, of course, of Western Australia, because Western Australia has, for a very long time, I guess you could argue, wanted to be its own country, and now I guess the paperwork's going through. The reality is WA may very well remain closed until the state election in March of next year. Now, nobody really knows exactly when. Nobody knows when international travellers will be allowed back into WA, not to mention interstate travellers. But that is the assumption they built in, so that there would be more freedom of travel in terms of interstate travel by the end of this year, so 2020. Now, that could obviously change. We could have outbreaks. We could have COVID case numbers increasing. What happens if that number changes? The next key variable is really international students. And this is particularly critical for cities like Melbourne, heavily reliant on international students. You've got some cities, or some suburbs rather, in Melbourne, in Victoria, that are, where rental prices are about 45 to 50% reliant on international students, because that is their entire demand base. So what happens if the students don't come back quickly enough? Or what happens if they come back faster? Where do those numbers look? And where do they actually head going forward? The FX rates is another one. The Treasury has assumed that the Aussie to US dollar rate will remain at around the 72-cent mark. Our view internally is that that's probably a little on the high side, and that we may see a little softness below that, but probably not too far off. Population growth, well, look, probably no major surprises there. As Carlo's already touched on, net migration into Australia is going to remain very low. So all we've really got is natural reproduction, natural increases in that birth rate, or in that population rate rather. We've seen a baby bonus announced in Singapore. Will Australia follow suit? I guess there'll be a lot of people hoping so. But look, I think at the end of the day, we're going to have to see some sort of boost in terms of new births to support all of this debt being raised.
Jarrad, just want to quickly say on the iron ore, if the iron ore goes from the current price to $55 a tonne, the Commonwealth Government lose $6 billion in revenue, company tax and royalties.
Great point, Carlo. And that's quite a significant number, I think. And yeah, the question is, where do we actually land between where we're currently sitting and what Treasury is forecasting? Now we do have one question here, which I might just cover off now, given it's relevant to this current page. Is the baby bonus in Singapore just for citizens or PR, or is it for everyone? My understanding, and I must admit I can't say I've applied or read the T's and C's, my understanding is it is for PRs and Singapore citizens. I don't know that it's for EP or S-Pass holders, but I could be wrong, so we would have to check on that. So yeah, great question, but certainly one to have a look at. But let's push forward. So, Carlo, I'll hand over to yourself in terms of what the budget changes mean for Australian residents.
Okay, this is probably the biggest one. The personal income tax cuts, as probably a lot of you are aware, they've actually brought them forward. They were meant to come through next year, but they've pushed them and actually sort of backdated them to 1 July 2020. There's been no change to the actual tax rate itself. It's just the bands have been moved. So you've got a zero tax rate there that hasn't changed from 0 to 18,200. Then the 19-cent bracket has been pushed out from 37,000 to 45,000. Then you've got the 32.5. That's gone from 45,000 to 120,000, and the 37 has gone from 90 to 120, and the 180,000, the top marginal rate has remained where it is. They were legislated anyway, so there's really just an amendment for that to happen to bring those forward. The interesting thing is that the 1,080 low to middle income tax offset was going to be removed once those new tax cuts came in, but because they've been brought forward, the government will keep them in for this year. So you will still get that 1,080 credit if it is applicable. The other thing to look at there is that the low income tax offset increases from $445 to $700. Okay, the economic support payments. Pensioners and support payment recipients, which include carers, Commonwealth Senior Health Card holders, who else? There's a wide variety of recipients who will receive another $250 in November and early in 21. The thing is that the actual pensions are indexed every September. They didn't get an indexation this year because of the inflation rate was very low. So the government is giving them the $250 and those two payments to compensate them for that. Other measures were the granny flats removed from CGT. This is quite a complex area, but as to say that there will be no capital gains applied where there's a family arrangement or their personal ties. So it eliminates the possibility of being subject to capital gains tax. It still does apply to commercial rental situations. The first home loan deposit scheme, additional 10,000 places for the first home loan deposit scheme. The first home buyer can enter the market with as little as 5%. The other 15% comes from the government. So therefore, the actual first home buyer doesn't have to pay the mortgage insurance, because under current rules, you've got to have 20% deposit. Otherwise, you get hit with the mortgage insurance. And this can be quite costly and deters first home buyers into the market. Other changes were to the aged care. They want to get a lot of the elderly away from the home care and basically get that care at home. There is an additional 1.6 billion to help them with that, and additional 400 million in infrastructure in an incident response scheme and monitoring to help with that as well.
Perfect. Now, Carlo, we've got a question here that I thought we might just touch on, given relevance to this particular slide, just in relation to the first home loan deposit scheme.
Yes.
Now, this may be a complex one. I'm not sure if we have the answers straight away, but the question is really in relation to somebody who is an Australian citizen or a PR, who's owned a property or primary residence elsewhere, but never in Australia. Could they be eligible for the first home loan deposit scheme?
Great question. I'm not 100% sure.
Yeah.
Yeah, we need to look into that one and probably get back.
Yep. Yeah, I mean, my assumption would be no, but yeah, we will confirm that one and just get back to you, because yeah, typically it would apply similarly to the primary residence, whereby
Correct.
if you have a primary residence offshore, then you can't claim your onshore Australian property as your primary residence.
Yeah,
But
I
let
would
us
say,
get back to you on that one.
yeah, I agree. I'd say no, but we'll check that out.
Perfect. Okay.
Okay. One part of the budget that actually got very little change was superannuation. Other than a couple of these things that are just, well, they probably don't mean much to most of us, and are probably for more load balancers and people starting off in the working life. The first one is no more duplicate super funds. What generally happens is that you get an 18-year-old goes to work, the employer asks, where do you want your super? They say, I don't know and I don't care. So the employee sets up the default fund. By the time the person is 30 years of age and changed a number of jobs, they end up having 5 super accounts. And it's costly. Generally, over a period of time, fees eroded, and the member ends up with nothing. So what the government have done is that they will tag one default fund to follow that person everywhere. So they might have 5, but when they go for a new job, they'll nominate one. The ATO will nominate one if the member doesn't, and that will get pinned to that person unless the member specifies it to be paid elsewhere. Again, it's generally for lower balances and people who aren't really interested in their superannuation until generally what happens later in life when they hit 40, 45, when the balances become bigger, they start to have a closer look. So that's one of the initiatives in the superannuation space. It won't affect most people, but it is actually a good idea, and it should save a lot of fees for those members as they transition through their working life. The other thing is this benchmarking of the default My Super. From July 2021, if that default fund has been underperforming compared to the benchmarks, that default fund needs to notify the member that it is underperforming. I don't really know what the benefit of that is. Again, if you've got an 18-year-old kid and he gets a notice saying that his fund's not performing well, he ends up just being more disillusioned with the system than anything else. But we'll just have to wait and see. So I think they're just trying to make the super funds a little bit more accountable. The ATO is going to issue a new tool here where the My Super products you can compare fees and performance. Again, I'm not sure whether an 18-year-old kid's going to jump on there and really be interested to see what the funds are returning and what the fees are. But again, it's probably a step in the right direction. The next one, the enhanced trustee accountability. They should be doing this anyway. So there's no, as far as I can see, I don't know what the changes are. They should always demonstrate reasonable basis for actions within their own super fund, and always best interest duty for the trustees of the super fund. So that's just a no-brainer as far as I'm concerned, but it's in there anyway. Okay, Australian businesses. The things that that have been announced for Australian businesses is the job maker. As I said, we've had job seeker and job keeper. Now we've got job maker. Depending on your age that the employee employs a new person, if the age between 16 and 29, they will receive a $200 a week subsidy. If they're a little bit older, 30 to 35 year age bracket, they'll get $100 a week, and 12 months up to $10,400 per position. The thing to note about this, and there's a little bit of rumour running around it from some of the business owners who employ, say, 10 people, they might let a couple go and re-employ them under the new job maker. It goes on the head count. So if you've had 10 people working in your business as of today, and you decide to let go of a couple and then re-employ another 2, you won't get the job maker. So you've got to have a 10 head count today. Tomorrow you hire a new person, you've got 11 people on your books, you're entitled to the job maker. The capital asset deductions, now this is the big one. So there's really two big parts to the budget. One is the personal tax cuts, and this next one, the capital asset deductions. So businesses can fully depreciate the asset that they purchase immediately. Now there has been the asset instant write-off, 20,000 that they introduced a few years ago, but this is right up to 150,000. So for example, a farmer who wants to buy a new seeder and it's $60,000, immediately gets a $60,000 tax deduction in the business. Generally, what would happen previously is that they would have to depreciate that over the life of the asset, and that could be over 5 years or 10 years or whatever that is. But now, whatever they spend, fully deductible to that business in the year that they purchase it. And it also applies to second-hand assets as well. The other thing, carried back losses. Now, this is an interesting one. It was actually introduced by the Gillard government for a year and then removed. Basically, you could, if you had a loss, you could carry losses forward. It's a bit like having a capital gain loss. You can bring that forward. In this case, the capital loss that you may generate this year can be offset against previous year's profits. So, for example, you make a $100 loss this year and you had a $200 profit last year, you can go back and amend it and offset that $100 loss against that $200 profit and get the tax applicable. A couple of rules around it. The refunds can't exceed the company's profits, as you would imagine, or generate a franking credit. Okay, retraining benefits. A lot of detail here. This is just a very brief overview. There's some FBT exemptions for retraining, reskilling employees for new jobs. It doesn't apply to university placements. Government looking to allow employees to deduct personal expenses for retraining. Corporate residency. Actually, Jarrad, I might just let you touch on that one there, if you don't mind.
Yeah, certainly, Carlo. So probably an important one for some Aussie expats. Obviously, a number of us have Australian businesses back at home, and there is always that grey area or the concern or turning a blind eye, as many choose to do, in terms of actually filing tax returns and where is the company tax resident. We've seen it with a number of clients over the years. But what essentially this information or this clarification is outlining is that if you have a business and let's say it's registered in Singapore or Hong Kong or the US or wherever it may be, that is largely operating with Australian clients, or control and management of that business is in Australia, then it is an Australian tax resident. And as such, it will pay tax in Australia. There's no grey area. If control and all of the important decisions are being made onshore in Australia, the clients are in Australia, the business is operating in Australia, it pays tax in Australia. It doesn't matter if you decide to keep that money in Singapore and keep it out of the eyes of AUSTRAC or other authorities. That is the rule now. So I guess an important clarification and a beneficial clarification, perhaps not a positive one for many, but nice to have a bit of clarity, I guess, when it comes to corporate tax residency.
And last one there, I think new apprenticeships, just there's a whole lot of wage subsidies that are on offer there. They're paid in arrears, and there's a start date that they need to apply by. So that's for new apprenticeships. Okay, what's missing? Superannuation caps. No changes to super at all. As I've mentioned, they've just tinkered around too many small balances out there. The caps remain in place. There was a lot of talk about the SGC increase next year being stopped because it'll harm businesses and so forth and so on. That remains. So whether that comes in the next budget, who knows? But very, very little on the superannuation front. So we'll just have to wait and see. the governments generally like to tap into that big pool of money. So we'll see what happens next budget. The job seeker supplement ends at the end of this year. What happens with those people is the big one. They've been jumping up and down for years and years that they don't get paid enough and they can't live on $40 a day. What happens when that reverts back to that? That's the big question. There is a lot of opposition from the Greens and Labor and Independents saying that it should be increased. The current government don't really want to look at it, but we'll just have to see what happens in that front. I don't know whether it'll go back to that $40 a day. We'll just have to wait and see. Surprisingly enough, there wasn't anything in there for the big end of town. Would keep a lot of people happy, I'd imagine. People think they get enough as it is, so nothing in there for them. We got nothing really on the update of international travel with the borders and so forth. I imagine that's still a little bit too early. Childcare reform. It's great to have all these jobs and stimulus into the system, but what happens when both, mum and dad are at work and somebody needs to look after the kids? What happens in that front? It's still very expensive. And this is probably the big one, is the real tax reform. And what we mean by that is that we haven't had tax reform in this country really, or major tax reform, since 1985 in the tax summit. So that's what, 35 years? We had some tax reform under Howard with the GST. Ever since that, it's all been tinkering. So we haven't discussed income taxes. We haven't really discussed corporate taxes, fringe benefits, capital gains. The whole lot hasn't been put on the GST. It hasn't been put on the table. As they've used the coronavirus pandemic as not an excuse, but from a conservative Liberal government to pump, prime and borrow to get the economy going, it probably wasn't a bad idea to put the tax reform on the table and use the coronavirus pandemic as an excuse. Generally, what's happened each time we've had some ideas about tax reform going to election, it generally doesn't get up. It's a hard act to sell. And just to give you an example of that, with the franking credit debacle that the Labor Party ran at their last election, that a lot of misinformation on that front, that cost the Australian taxpayer $5 billion a year in those excess franking credits, going to $8 billion in the next 3 years. I don't know if that's sustainable, but somebody at some point needs to do something about it. So you just can't keep kicking the can down the road. We need to do something about putting tax reform back on the agenda. And quite frankly, it was the pandemic. They could have used it as an excuse to look at it.
Yeah, completely agree, Carlo. And I think it would have been a good opportunity to perhaps retain some of the Australian expats who are stuck in Australia at the moment, and maybe even convince a couple of them to stay. But sadly, the $1,000 or $2,000 that we might save in tax each year probably doesn't compare to moving back to Singapore or Hong Kong. So let's get into some of the opportunities, the changes for expats. Now, as you may not be at all surprised by, there are very few. Expats, I guess, are often the forgotten bunch. We often vote one way, and that really hasn't changed over the years. And I think if the main residence exemption changes showed us anything, it's really that nobody cares about us, given that we've left the country. But let's get into some of the things, some of the areas that that I guess are presenting opportunities, and most importantly, some of the areas that we've received no commentary at all. Now, one of them is really the concessional super contributions. Now, we didn't see any change in the budget, but this is a relatively recent change for Aussie expats. And what this is for those of us, or those Australians that work in Australia, when our employer is contributing to our super fund, we can contribute up to $25,000 a year in the form of both SGC, so our employer contributions, and any additional salary sacrifice contributions that we elect to make. Now, from the 18-19 financial year, we can actually carry those forward for a maximum of 5 years. Now, obviously, for anyone who can do the maths, that's 5 times 25,000, that's 125,000. If you're a couple living and working offshore, that's $250,000, which is quite a substantial potential tax deduction to be utilised in future years. So while this wasn't an important budget update, it also wasn't scrapped. So for anyone looking to move back to Australia in the next 1, 2, 3, 4, 5 years, or even beyond, to be honest, I would certainly seek some advice or consider this, or consider this as an option to at least ease the tax burden as you re-enter life in Australia. Now, the corporate tax residency, we've already touched on. Anyone running a business in Australia as an Australian expat, you need to be aware of the rules. There's not really been any major change here. It's more just a point of clarification. Any business that is genuinely doing business in Australia, decisions are being made in Australia, will pay tax in Australia. No real surprise, BHP and Rio, as many will be aware, tried to get away with it for years, shifting profits offshore to Singapore. And I don't know if we have any employees of either on the webinar with us this evening, but as many will be aware, their office footprint in Asia has certainly decreased as a result of some of the changes when it comes to their tax. So not a great deal of changes in terms of the opportunities for Aussie expats. I thought I would just highlight here this evening one of the important rules. There have been many Australian expats caught in various countries, including Australia for many. The current numbers suggest there are around 10,000 Australian expats currently stuck in Australia, unable to return to their country of residence. Now, there are two important rules when it comes to the ATO and I guess avoiding or reducing your chances and likelihood of being taxed in Australia. One of those is that you are ordinarily a tax resident of another country. So whether that be Singapore, Hong Kong, New York, US, Europe, UK, wherever, you ordinarily live in another country. You have a lease or a home there, your clothes are there, your life is there, your job is there. You ordinarily live there. More importantly, and is becoming more and more relevant for many, is your intent to return to that country of residence. Now, that doesn't mean I plan to, but I just don't want to yet, because I'd much rather enjoy the freedom of Australia. That means that when you're physically able to, and your country of residence will accept you, you should be on the plane. So it's not so much a personal choice anymore. If you don't want to pay tax in Australia, get on the plane and get back to your usual country of residence. Now, as always, this is a tax consideration, so seek advice from your accountant, your tax professional, but tread with caution. This is not something to be ignored. For those of us that live in Dubai or Singapore or Hong Kong, many for the reason of paying significantly less tax than Australia, certainly an important one to be aware of. Now, what's missing when it comes to Aussie expats? I mean, gosh, everything, I guess. Australian expats really didn't get a strong mention, but what are some of the key issues that haven't been raised? Well, the main residence exemption that we were all fighting to maintain as expats has not happened. So if we sell a property in Australia where we might have had that main residence exemption previously, that's all gone as of 1 July. So that exemption's gone. So you do need to do your homework if you own property in Australia that you lived in previously. As far as your tax residency is concerned, there really are no updates other than what I've already covered. So if you are stuck in Australia or you're stuck in a different country that's not your normal country of residence, please do your homework, seek advice, because the last thing we want is people facing unnecessary tax bills. The corporate tax residency, well, we've already covered. There are no positives, but at least there is some clarification. The international travel update, well, there really aren't any updates to speak of. As many of us that live in Singapore would have seen, there are many arrangements for residents, for people stuck in other countries to return to Singapore. but very little ability to actually go in both directions. So very little reciprocity at this point in time. My suggestion would be watch that space closely, because I would expect that will change in the not too distant future. And as Carlo has already kind of covered, well, are there incentives for Australians to remain in Australia, to stay in Australia? I mean, I can honestly say from conversations with our clients, no. Many people view the tax reform to be a missed opportunity. Very little incentives, I guess, for the brain drain to be reversed. A lot of smart Australians, highly skilled, highly educated Australians are still searching for greener pastures offshore. And I really don't think that the reforms, the incentives, the various programs on offer are really going to change a great deal. So perhaps a bit of a missed opportunity there. Now we've just got a question here that I might just touch on here. Tax residency for expats. What is the date that we are technically and physically able to return back to Singapore? Yes, there are many ways to interpret this. The critical question, I guess, is really around the ruling with your particular country of current residence. So if we view that to be Australia, you could argue that has been from around middle August that you've been able to apply to return, and officially definitely from the start of October. We've obviously had the official announcement that people returning from Australia and even mention of Victoria would either have less or no stay-at-home quarantine measures when they return to Singapore. So certainly if I was stuck in a different country looking to return to Singapore, I would want to, at the very least, be having my HR department, my employer, submit the application for me to return. If Singapore then rejects you, well, you then have written evidence that you've tried to return, it supports your intent to return, and they have then rejected you. So then you can apply again at a later date and remain in Australia, I guess, or wherever you happen to be, with a little peace of mind. So hopefully that answers that question there. Now we've got a couple of other questions. I do know that. I just wanted to acknowledge that they're there. We'll cover them as we get onto the investment opportunities. So Carlo, I might hand over to yourself to just talk us through the market reaction to the budget and what's been happening.
Yeah, look, the market reaction's been positive. I think the stimulus that's going to come through from the tax cuts and those depreciations for small business should get things moving in the right direction. The only thing I would say is that how much of those tax cuts will Australians actually spend, or will they actually save? The government would hope that they go out and spend, considering that the job keeper and seeker are coming off. But in terms of the market reaction, since things started to get leaked out last week in terms of the budget, we've had a 4% increase for that week and 1.4% today. The interesting thing is that if you notice there, on Friday afternoon, we had a bit of a dip, and that coincides with Trump being contracting COVID. So the markets are, I think, all looking okay and very positive to the budget, barring any tweets from Donald Trump.
Perfect. Now, I guess the question we're often asked is, well, with all that's going on, with Trump contracting COVID, with the election, with the budget, particularly the budget in Australia, where are the opportunities in the market? Where are we investing? Where are we positioning clients? And where are we investing personally? So these are some of the critical areas that we've been watching. The Aussie banks have remained fairly soft ever since the sell-off in March. And a lot of that's been driven by concerns around the Australian property market, concerns around their margins, access to funding, low interest rates. Our view is, with a long enough time horizon, being probably 3 to 5 years, I think there's going to be some pretty good opportunities in the Australian banks. They've always been very good income plays, the concerns around the downturn in the Australian property market are largely dissipating. So I think there's going to be some pretty good options there, particularly for those that are just looking for relatively low risk, stable income plays over time, and are prepared to ride out a bit of volatility. The other one is really around sustainability, ESG. Now, this is not, pipe dream, hydrogen energy, wave energy, or any of that nonsense, but more companies that are genuinely investing in sustainable practices. One of the best non-public examples would be IKEA, which for a long time was discussing, somewhat publicly, removing plastic from all of their packaging. They have significantly progressed down that path, and we're now seeing increased pressure on a number of other players in that space. We've got Nestle looking to reduce the layers of plastic used on packets of chips or crisps from anyone from the UK, from 3 layers to 2 layers. We've got playing card manufacturers, for anyone who plays baccarat or poker, looking at recycling measures. How do you recycle products that are made from both plastic and paper? So there's a lot of development, a lot of money flowing into that space. The lip service that was paid over the last decade is now ceasing, and real money is flowing into that space. So we like it a lot, and we're closely monitoring opportunities there. The whole cybersecurity, reg tech, so regulation compliance technologies, we think there's huge opportunities there. We're moving very quickly from, the days of antivirus and cybersecurity malware software on your laptop to everything existing at a cloud level. We need to be able to access data from every device that we own these days at a moment's notice, whether it's our watch or our phone or our laptop or our iPad or our home office. And our view is, with COVID, that's really accelerated the flexible working arrangements that we've seen over the years. So I think we're going to see an increased demand and increased amount of money flow into that space. And for those of us that live in Singapore, all we need to do is look at Grab, which I'm sure will shortly be issued with a digital banking license. We've got AntPay being listed. We've got all of these companies looking to get a stranglehold on the Asian populace when it comes to payments. And all of that requires cybersecurity, compliance, regulation technologies behind it. The whole digital e-commerce space, apologies, will come as no surprise to anyone. Everyone who didn't shop online last year is now shopping online. For those of us that did shop online, we're now buying things online that we never thought we would buy online, and that's only going to continue. And a lot of that's going to lead to more targeted advertising, more personalized advertising, the whole shopping experience, getting a lot faster. And we're already seeing, payment providers, Visa, MasterCard, PayPal, look at new payment solutions, whether it be replicating PayPal or other solutions, to make that whole process faster, enable us to shop that much faster. And one of the other really exciting areas that we see is really in esports and gaming. And I'll just hone in on esports, because it's a very interesting space and one that we don't think is really receiving enough attention, and particularly in Asia. Esports is for anyone who's not already aware, it's electronic sports. It's, to put it in very simple terms, people playing sport on their PlayStation or digital device. The money that is flowing into that space in the form of advertising is phenomenal. And to just hone in on one stat, if we look at India as being a very male-dominated, particularly in the sports field, country, which would be anywhere from sort of 80 to 95% male in terms of most of the sporting arena. If we look at esports, it's actually 40% female. And what that leads to is the companies like Nike, Adidas, Puma, all of these high-end sporting brands being able to tap into a whole new target market consumer base that has the money and wants these products. So we think the money that will flow in there will be quite phenomenal. So that's sort of a bit of an overview of some of the sectors we're looking at, certainly not all of them. but just some of the highlights, I guess, in terms of sectors. Now, Carlo, anything to add, I guess, in terms of sectors that we're looking at holistically, or investments?
No, I think you've covered them off pretty well.
Wonderful. Well, I'm mindful it's 6:59 by my watch, so I think we've done very well on timing. So just a little pat on the back for us on that front. We'll get into questions. I did just want to touch on anyone who has, any more detailed questions or anything more complex they want to look at their own situation and don't want to cover it off on the webinar this evening. We will send out a note. We'll send out a copy of the recording as well. So if you do have any key questions or you want to review your own situation, it's all obligation free. So you'll be able to reply to the note tomorrow, send us through your questions, and we can touch on those offline. But we might tackle some questions. So we've got a few here ready in the wait. And Carlo, I might throw this one to yourself.
Mm-hmm.
And this is in relation to the Australian government infrastructure spend, obviously a key focus of the Australian budget this year. What are some of the ways you might look to position yourself to capitalise on this in the Australian equities market?
Yeah, very good question. Some of the infrastructure stocks, like your Transurbans and things like that, Macquarie Infrastructure, they're the ones that you sort of play in that space. Even the Magellan Infrastructure Global Fund, they've got exposure here in Australia as well. So you would look towards allocating investment dollars into that space. The only issue with that, it tends to be put out, a lot of these infrastructure plays and the works that go with it tend to go out to tender, and it just really depends on who wins that tender. So you've got those other stocks that have got that exposure to it. And there is a time lag. As I said, a lot of the infrastructure infrastructure spending will take time to come into the market. They don't happen overnight. So it's very difficult because of the time frame in which they've got to get up and running. I'm not sure. I might have to have a bit of a look to see which ones are shovel ready, to see if you can get that sort of quicker impact into that exposure.
Perfect. So I guess sort of take a couple of key takeaways from that. I guess if you're looking to invest in individual stocks, you'd certainly want to do your research around which companies you're investing in, or have someone do that for you, I guess. Okay, now the next question we've got here is a little bit of a tax question, so I might just tackle this one. So the question is really around someone who's a non-resident of Australia, sold a property in a country other than Australia and returned to Australia after that. Would there be any tax complications in Australia? The answer is 99.99% of the time, no. Australia taxes on worldwide income for Australian residents. And Carlo, correct me if I'm wrong here. But if you've already sold it offshore, it would really be down to the double tax agreement between the country your property exists in or is physically located in, and your country of tax residence.
Correct.
Would be what really dominates that.
Yep, absolutely.
But excellent question, because we certainly face have a number of clients with that situation with properties all over the world. So the next question we've got here, and Carlo, I'll throw this one to you, a bit of a curly one. Could we see negative interest rates? And if so, what are the implications to borrowers?
Very good question. Because it's a new phenomenon, no one really knows. The Reserve Bank governor has already said that he won't be looking at negative cash rates. What that does is a big unknown. So we're not really sure in terms of the economic, in terms of the borrower. So I would imagine that you'd never get a true negative interest rate at the retail level. It's more to do with the funding behind the scenes between the Reserve Bank and the lenders, not so much the consumer. It's a bit like the negative interest rates that you get on a government bond issued by the German government. A lot of people don't understand that if you give them 100,000 in 10 years' time, they give you back 97. So you've actually lost money. So a lot of people go, well, why would I do that? Well, you could go and put 100,000 into a Greek bond. I'm not sure what they're trading at, but they could give you a significant higher rate, but do you want to take the risk? But to answer your question, I don't think we'll see it here. And in terms of your borrowing rate, I don't think it'll ever be negative.
Perfect. Thanks, Carlo. I don't think we have any other questions. If anyone else has anything they'd like to raise, please do fire them through. But otherwise, we might wrap up there. We're just after 7 Singapore and Perth time. So we'll wrap it up, and I'd just say a huge thank you everyone for joining us this evening. I do hope you found it informative. Hopefully we've covered off some of the key points on the budget. Thank you very much to Carlo with Ally for your input this evening. And yeah, as I said, we'll be sending out the recording to everyone tomorrow. So yeah, if you do have any other questions that we've not covered or anything you'd like to look at for yourself, please do reach out. But otherwise, thank you very much, and enjoy the rest of your evening. If it's early in the day, then have a great day ahead, and we'll speak soon. Thank you.
Good evening.